Well, this video really started life as a more generalized video on short selling, which is a topic I do want to cover because I'm very interested in the effect of these short selling activists like the Hindenburg Group, who produce these massively complex reports on companies that they either think are overvalued or which they think are perhaps just a giant scam. And I was heading down that road until I came across this chart, which was, it's just a stock I'm following. This is Nvidia, which has been in the news of late, and which you should be all aware of. And whilst I was looking at this chart, I noted down the bottom that, and this is from IG Markets, this chart, there's this feature down the bottom called client sentiment. So I thought, well, for shits and giggles, let's see what that says. And it says something very interesting. It says this. It says that at present, 62% of all IG clients are currently short Nvidia. So let's go back and have a look at the Nvidia chart and see if that makes any sense whatsoever. Because to my way of thinking and my observation, and it doesn't really matter which time frame you use to split this data up with, Nvidia is going up and has been going up for some time. So to be short this instrument seems to be somewhat insane. And I thought, well, I wonder whether that's actually confined to simply IG's client base, whether there is something intrinsically about them that causes them to look at the chart that is clearly heading up and has been heading up for some months and go, well, I'll go short that. As a quick side note, is it any wonder that most CFD traders lose money? And so I stopped my sort of generalized research into short selling just as a general topic, which I will get around to one day. And I looked at some bits and pieces from the broader market as to what is happening with short sellers in Nvidia. And I came across this chart. And it says that currently, mark to market, Nvidia's rally has cost short sellers about 8.1 billion in losses. So it seems that this is not an isolated incident. It is something that seems to be quite common, that for some reason people look at a stock like Nvidia and go, well, that's obviously a short, and are currently having their asses handed to them. So I dug a bit deeper, and it is a global phenomena that for some reason traders have looked at this stock and simply gone, well, I will short that because it's clearly going down. Now, I think I actually understand the reason why they have done that, and I'll come to it in a moment. And I'll also talk about the irrelevancy of their reasoning and how foolish it is. So let's go back to a longer term chart of Nvidia. This is a weekly chart, and it quite clearly shows that Nvidia had a breakout in February and since then has almost doubled. And it's done so under a reasonable increase in volume. So you would think that anyone seeing this would think the stock is automatically a buy. Well, you'd actually be wrong. I did a bit of further digging into analysts who cover Nvidia, and I looked at what their actual recommendation for the stock was. And you'll see I've highlighted some here in red. Now, in terms of breaking this table down, we have date, the analyst or the firm, their current rating, and their price. This, I'm assuming, is their target price. And you'll see those highlighted in red are marked as upgraded to buy, because whilst they probably had not been recommending to their clients to short sell it, they had clearly had access to a chart like this or a variation of it and been neutral on the stock, when in actual fact the only recommendation you could make for the stock, particularly after the breakout in February, was that it was going up and you needed to be long this particular stock. And I found this very interesting little graphic. I've stuck the link down the bottom where you can have a look at this for yourself. This is from the Business Insider website. And you can see across the top, we have total analyst 99, buy rating 75, neutral 22, sell 2, which is intriguing. The neutral is also intriguing, but it's the chart I'm interested in. It's broken down into a series of points. The black line is the historical price of Nvidia. Blue line is the target price. Green are those analysts that are covering the stock and their price thoughts or their price recommendations, or where they thought it was going to be at that point in time. You'll notice something interesting. They are universally bullish, by and large, and I do say by and large because there are 22 neutral ratings and 2 sells, but they're also vastly over-optimistic. They largely miss the price targets by quite a margin. And this is one of the problems, in that you get this exuberance to the upside from analysts. And that is problematic for people, because this is part of the rose-coloured glasses that analysts see the world with. There is nothing wrong with their recommendations per se, because they do coincide with Nvidia's upward swing. The cynic in me would say that that is more luck than anything else, given my long historical connection with analysts and my observations of their abilities. But it doesn't really matter. What matters is that this group of analysts, all 99, are presented with exactly the same data, but they interpret it in very, very different ways, particularly those who are neutral and those who have a sell rating. But then we come to this notion as to, well, why does the majority of people who are trading this stock, in terms of what we've seen from IG markets, have an opinion that the stock is going down? And I thought long and hard about this, and my initial response, my gut response was, well, it simply comes down to the fact that most traders have no idea what they're doing. And they don't actually understand that markets will remain irrational long after you have become insolvent. And that's one of the harsh lessons of trading, is that what matters is the market's opinion, not yours, or your interpretation of the data. And I think in part why people have come to the strange conclusion that Nvidia was a short sell was simply from this. And these are a few news items I snipped. All I did was Google AI bubble. I will put my cards on the table. We are beginning to use AI quite extensively. It's beginning to perform all sorts of tasks from us, from looking at trading systems through to looking at simple assistance for our websites. But I will qualify that. AI at present is a bubble. Just like NFTs were, just like Bitcoin was, just like 2 years ago lithium stocks were. They're simply a bubble. And you can tell they're a bubble because every time you open Twitter or LinkedIn or Facebook, all people are crapping on about AI. Now, AI will probably change the world, and it will alter the way we do things quite dramatically. But at present, in its embryonic stage, it's a bubble and everybody's jumped on the bandwagon. If you want to see your share price go up, change your name from Bob's lithium stock to Bob's AI stock, and your share price will go up. And so this perception that it was a bubble, but also that perception coupled with the things that, well, it can't really be worth that much, they've led people to look at this and go, well, I will short that, which in turn means they get belted. But coming back to that notion that it's a bubble, and these are 2 news items I just wanted to highlight because they have 2 interesting statements in them, and they summarise my feelings about bubbles. Well, I suppose I could summarise my feelings about bubbles. I really don't give a shit. But they say it much more eloquently. They point out the fact that a bubble is a boom-bust process, and it is. That's just the way it is. The wheels will fall off this sooner or later, and there will be tears. Because the flip side of this is that people are buying Nvidia because it's a chip producer. There is an assumption, for interesting reasons, that having AI will mean that the world will need many more chips. We run AI on all our existing machines without changing them. I run AI on my phone without needing to upgrade it. So that's somewhat of a long bow in terms of the argument you present yourself with. But there is a final point, and it's this point here by Pepperstone that I want to concentrate on. And it says that maybe AI tech is an investment bubble, and that's okay. It doesn't really matter whether it's a bubble or not. All that really matters is that you have some mechanism, some process for taking advantage of that. And this is the important thing. You need to be able to spot these occurrences as they're unfolding. And you can only do that with a systematic approach. And that systematic approach defeats luck, but it also in many ways defeats your emotions, so that you are not one of these people who, when you look at a chart of something like Nvidia, you go, well, that's brilliant. Yes, it's gone up. I think I'll go short. Your process would stop you from doing that. And what your process is designed to do is to place you in a position whereby instead of the gibbering that you hear, which may cause you to be one of these people, you're actually one of the people who look at something like this stock and go, well, my system says to me, my perception is that it has broken out of resistance and it is now trending up. And if I were to apply any form of basic breakout system to this, and it wouldn't matter what it was, it would have shown that breakout from 180 to 190, and price doubles from there. But we come back to this notion of being systematic, because systems defeat chatter, they defeat these stories. And that's the most important thing about the system. It means that you're able to sit back and dispassionately look at this and go, well, yes, look, I accept that AI is a bubble. I accept that it is a boom-bust process. But at the end of the day, I really don't care, because my system will protect me and my system will enable me to make money out of it.